Welcome to a special edition of the CreditSights Global Market Update focused on Iran, the recent escalation, looking at market and cross sector credit implications. My name is Winnie Cisar. I'm the Global Head of Strategy at CreditSights. And today we are going to be bringing you a lot of information from both the CreditSights team and the BMI team. Joining me today, I have Zach Griffiths, our head of investment grade and macro strategy, Regis Chatellier, our head of EM sovereign strategy, and then two very special guests from BMI. We have Cedric Chehab, our chief economist at BMI. If you are familiar with the Credit Sights podcast or other webinars, you have probably heard him speak before. He is one of our fan favorite recurring guests. And then Ramona Moubarak, head of Middle East and North Africa country risk and global banking. Thank you all for joining us today. So, per usual, we always like to ask the audience questions to get a sense of where everybody stands on expectations in the immediate and longer term. And I'm going to kick off our conversation today with a question for the audience, which is which conflict scenario do you assign the highest probability over the next 4 to 6 weeks? Will we have a swift de escalation within 2 weeks? B, contained regional conflict, C, extended regional war, or D, a full Hormuz Strait blockade plus broader escalation? All right, why don't we go ahead and see what the audience is thinking? I'm just going to give it another second or two to let people get in their votes. Okay, I think that we have reached critical mass. Moment of truth is all right, survey says almost half of the audience thinks that we're going to be in for a contained regional conflict. Second most popular answer with 29% extended regional war, followed by swift de escalation, and then full Hormuz blockade and broader escalation. Definitely the tail risk at 6.9% of the audience. All right, with that context in mind, I'm going to go ahead and bring in Ramona on the BMI team. Ramona, where does the war in Iran currently stand relative to your expectations heading into the year?
So basically, I'm just like thinking about the the results of the survey. I'll come back to this in a little bit, but just a few words on the slide or the flow chart on the screen. This is where this is our flow chart since mid-January. Basically, when protests in Iran subsided, and we had a binary outcome from the statu quo, which is either diplomacy or large-scale war. And with diplomacy failing, we shifted to our large-scale war scenario. Now, within this scenario, we had three options. Can you please move to the next slide? Yeah. So these were our three scenarios for in case of a large scale war with between the US and Iran. Now, the scenario one, I call it the plan. So this is what I thought the US would aim for: decisive, short-lived, contained spillovers. And one of the triggers to move to scenario two is the forceful Iranian retaliation. And basically, from day one, we entered the war in scenario two. So our scenario two is short-lived, and this is 2 to 3 weeks. President Trump said 4 to 5 weeks, so let's say up to 4 weeks of a large military campaign, greater regional spillovers with at a minimum of a partial disruption to Hormuz. So this is where we stand here. Now, in terms of like what are it's for us to assess the timing for the war. Let's look at at the objective. Basically, the US has set several objectives. One, to destroy Iran's missiles, its missile industry and navy. Two, to ensure that the regime proxies can no longer destabilize the region. So we've seen attacks on Hezbollah in Lebanon, Iran-backed groups in Iraq. So the military campaign led by the U.S. and Iran is also, and Israel is also moving into this direction. There's also a third objective which related to the nuclear program. So we're expecting doubling down on the nuclear facilities, research facilities. There's a fourth location that hasn't been targeted in the the June war last year, and of course implicitly moving things towards a regime change in Iran. But this has been dropped from the official list. So this means that if it doesn't happen, it's not part of the official objectives that the U.S. set in its for its campaign.
So, as we're thinking about how we're already kind of at scenario two, how do you think about the off ramps for de escalation?
Now, the the off it's like thinking about it from an exit strategy. So the easiest way is meeting these objectives, and one thing we've been noticing is the sustained decline in the intensity of Iran's of the number of launched missiles and drones by Iran. Now, it's unclear if this is part of an Iranian strategy or if it's the result of the attacks and destruction of its military infrastructure. Or a third option would be: is this a signal from Iran of that this de-escalatory signal from Iran? In all
Mhm.
cases, whether it is a result of the campaign or a signaling from Iran, this feeds into one of the objectives set for the war. Then the second one is the sustained or new attacks on the nuclear sites, the research facilities. The third one, as I said, is the ongoing or defeating of the proxies. And a fourth one, I would say, is restoring the navigation in Hormuz. That needs to be done as well for Trump to be able to declare victory in this campaign. Now, alternatively, we can see a humanitarian pause, allow for room for popular uprising in Iran, let's say, or a regime reconfiguration, i.e., defectors from Iran would reach out to the US, agree on the demand, and then start the de-escalatory process. And I would add, there are like some constraints that the US would be working on in terms of like preventing further escalations, like market reaction, oil prices further rising, domestic politics in the US as well, the pressure on the interceptors that are being heavily used to in this war by the US, by Israel, and also US allies in the region. So there are some considerations as well to prevent to keep it short and not let it drag as well.
Yeah, absolutely. That's really helpful context. I also want to note, I forgot to mention at the outset that we are happy to take audience questions during this webinar as well. If you have a question for any of us, you can feel free to submit that in the Q&A chat box. We'll try to address that. And then we also have the emojis going. So if you like what you're hearing or don't like, let us know for sure. All right. So, Cedric, I'm going to bring you in because I'm really curious about kind of the US foreign policy and some of Trump's more domestic constraints. Ramona just alluded to some of those. How do we think about that within the next steps from the Trump administration and Iran?
Yeah, thanks, Winnie. So, in terms of Trump's objectives, I think there are a few red lines. For example, the nuclear and reducing the capacity of Iran's ability to kind of send missiles to other countries and also sponsor terrorism. But the real red line, I think, is nuclear. And then the others are kind of shades of gray. And I think that allows Trump some flexibility to figure out and possibly say, look, I'm okay with what we've seen. And to Ramona's point of reconfiguration, it doesn't have to be a regime change. So what Trump might find acceptable is actually more kind of different shades of gray than we would think from the outset. You know, he's typically not ideological in that way, and he's very flexible sometimes, and he surprises everybody with the decisions he makes. And I think to the point of domestic constraints, so Ramona mentioned a little bit kind of the politics, and I think this is the real pressure point. So of course we have the midterms this year, and a big concern is of course affordability, which is something which started under the previous administration, but it has proven quite sticky because affordability is not an issue which goes away very easily. And if you do have a surge in oil prices, that really hurts real wages, purchasing power, and I think that could be very painful for Republicans at the polls, particularly if that's combined with quite a few losses in terms of servicemen and servicewomen in the U.S. And if you look at the chart, he's not polling particularly well at all. And we saw a little dip after the whole Venezuela and Greenland situation, whereby his supporters, the MAGA supporters, don't like his foreign policy, which is much more muscular, and Democrats don't like his foreign policy. So he doesn't have a lot of supporters from a foreign policy perspective. And I think one of the big concerns is that even though Trump has said that he doesn't want to get stuck in a forever war, there are concerns that actually the U.S. gets stuck in a forever war. And I think those are the major constraints that he's facing, domestically at least.
Yeah, I mean, I think it's really interesting leading into the midterms how people are viewing foreign policy and the really key intersection of affordability given the Iran conflict and the impact on energy prices. It's kind of a head scratcher to me that this would be a strategy that Trump would necessarily want to pursue heading into the midterms. So we have a question from the audience, Ramona, about can you address reporting the reporting that the Kurds may get involved and how you factor that into your scenarios and probabilities?
So the even before reports about the involvement of the Kurds, we did highlight, like under our regime reconfiguration scenarios, that the presence of minority groups, secessionist group with each their own agenda, that would be a destabilizing risk for Iran, especially if you look at the military strikes. They aim to weaken the domestic security apparatus, so leaving more room internally. I would look at it from an internal perspective, like stretching the regime internally, and also let it focus inside rather outside. Now, there's a risk here because secessionist movements are not very popular domestically. So my concern here, whether this would backfire in terms of triggering more support to the regime rather than against it. So it's a delicate balance in terms of like what their role is, what do they want to achieve, and if it's actually the plan is to fragment the country or just increase the pressure on the regime.
Yeah, absolutely. Um, there are a couple of more questions from the audience here. One is, how long do you expect Iran to keep sending missiles over U.S. allies in the region? Any thoughts there?
Well, if they have 200 left, they can, and launch one every day, they can sustain this for 200 days. So I think the question is not about how long, it's about
Mhm.
the efficiency as well. And like, would decreasing number to 2 or 3, would this be sufficient? Remember, one thing is, even the wars over the past 2 years, they ended with some sort of an agreement, whether in Gaza, whether with Hezbollah in Lebanon. So the de-escalation, the decline in the number of attacks allowed this to happen. So I wouldn't focus on zero rather than on a
Mhm.
trend and making it like minimal acceptable for the US to say like this is it, we're done.
That's great. One last question for you, Ramona, I think. Do you have any thoughts on whether the international airport in Tehran would be a target?
I don't have a thought about
Oh,
on that. I think uh, I wouldn't like. What would be the added value of targeting it at this stage? It's already closed. No one is leaving, so targeting it would probably upset the domestic population, or like if in the event of let's say a humanitarian pause, or foreigners wanting to evacuate their nationals, this would be won't be used. So I see. Personally, I see limited added value of striking the airport, since there's no movement in the airport.
That makes sense for sure. All right, we have a number of questions from the audience on markets. So let's go ahead and get into some market information. Now, things are changing very, very quickly. We have 10-year Treasury yields now up about 20 basis points compared to last Friday's close. Brent crude's up about 19%. And importantly for U.S. consumers, as Cedric was discussing on affordability, gasoline is up about 29% over the same period. Now, I would say market action has been very choppy and probably confusing day to day. We've had some pretty severe equity drawdowns. We saw that in Korea 2 days ago, but also some periods of broad-based stability, which honestly has surprised me quite significantly. Within the credit markets, cash credit spreads have been pretty slow to react, with CDS spreads a bit tighter, though cash indices are off of year-to-date tights by a good bit and also slightly wider on the year. Now, a lot of that widening move has been led by the lower rated cohorts in broadly syndicated loans, software, and technology. So there is kind of isolating the impact of the Iran war on markets within credit, and also what was already happening within markets with concerns around AI, software, private credit defaults, all of those things. When we look at fund flows this week, it's a little bit surprising to us, but fund flows were actually broadly positive on Monday and Tuesday across both developed markets and emerging markets, although we are seeing sizable inflows into money market funds both in the US and Europe. Quite notably, US fixed income is seeing much stronger inflows versus Europe and EM. And high yield, this is very surprising me, has actually posted inflows to start the week, whereas broadly syndicated loans have not. Now, just kind of a last thing on this, I think a little bit surprisingly, at least to me, is that the US dollar is only up about 1.3% since last Friday, and gold is down about 1.7%. This is a very big difference in market action than what we saw in 2022 when Russia invaded Ukraine. So, Zach, I want to bring you into the conversation because rates are clearly a big factor in this whole discussion. What are some of the moves in the rates market, or maybe lack thereof, that stand out to you on the US rate side, and then maybe also US credit?
Thanks, Winnie. So I'd say what's been surprising to me is perhaps just how quickly we've shifted to a selling off in global G10 government bonds. And when we did our weekly over the weekend, our initial thinking was you probably get a risk off flow into the least risky products like treasuries or bonds. And then over the medium term, we highlighted our view that maybe the concern is more on a bare flattening of the curve with inflation expectations, particularly at the front end, becoming a challenge. And so the medium term for us ended up being about 12 hours as the market began selling off basically the morning of this past Monday. So kind of looking at the market moves that you had highlighted, we're seeing some of the largest moves. We enlisted it in percent or basis point terms. If you want to look at it from a Z-score perspective, the most intense moves have been in the 10-year boom and treasury yield, followed by Brent crude, which is less surprising. And so looking at what the market is now pricing in for the Fed, it's pricing in fewer rate cuts in the near term, a shallower cutting path, and perhaps a quicker return to rate hikes, or the policy rate returning to around 3.5% over the next several years. So what you've seen is, as you'd expect, the front end of the treasury curve has been pushed higher primarily by break evens, whereas the belly and longer end have been pushed higher by real yields following those shifts in longer run policy rate expectations. So I think for now, it's all about the inflation pass through and not necessarily that risk on, risk off relationship that you would typically think between risk assets and treasuries. We think that probably remains for now. But to your point, Winnie, coming into this period, there had been a relinking between equities and treasuries to the largest extent since March of 2023, following SVB, the largest correlation between treasury yields and equities, and that has flipped fairly quickly. So for now, I think staying cautious from a duration perspective makes sense. And I think we'll get a little bit more perspective on this from Cedric and Ramona. Ultimately, it's going to come down to how long this lasts and what it takes to shift concerns from inflation to negative growth concerns, perhaps of elevated oil prices for longer. Cedric already mentioned concerns about real wages, concerns about spending power. When does that become kind of the trigger point? We don't think that it's right now by the end of this week or perhaps even next week, but that's the more medium term consideration, in which case some of these moves will probably have created a buying opportunity.
Yeah. So, Zach, I want to stay with you and just kind of to follow up a little bit. The case for U.S. Treasuries. We've seen 10-year yields rise a lot since just last Friday alone. I know that everything is going to kind of be contingent on how long this conflict lasts, how severe does the energy headwind and upward pressure on commodity prices end up being. What part of the curve do you feel kind of comfortable hiding in right now? And do you have a 10-year treasury level in mind that you just kind of close your eyes and start to buy?
Honestly, I think if the 10-year gets to 450, that's going to be, and that's not a crazy move from here. I think that's a good time to buy. Period. I don't think we're going to retest 5%. I think there have been a ton of reasons why treasury yields should be a lot higher than they are now over even the past year, and none of them have pushed treasury yields higher on a sustained basis. Instead of that being a case for more vulnerability, I think that's more confidence in kind of the staying power of treasuries amid all of these global concerns. Where to hide out right now, I think kind of sticking in the very front end, not taking a lot of duration risk. I think this underperformance of the belly of the curve that you can see evident in the chart on the right here ultimately is going to be a buying opportunity, but I'm not ready to step in yet. So I'd say kind of hiding out in the front end is probably the safest play for now.
All right. Hiding out in the front end makes good sense to me in the near term for sure. So, Regis, I would be curious to hear your take on emerging markets, sovereign risk, and kind of what has developed so far. This is, especially a question for countries that are geographically close to the Middle East, Turkey and Egypt. There are some questions from the audience on Turkey or those that are, major energy commodity importers and are going to feel that squeeze of higher prices.
Well, to be honest, the market reaction in EM was significant with volatility rising a bit. But to be honest, in the end, the repricing hasn't been very dramatic. Middle Eastern countries didn't suffer the most, fortunately, in the sell-off. In fact, GCC countries are still perceived as pretty robust credits with plenty of FX reserves. And also rising oil prices is offsetting the risk of the trend balance in public finances, at least partially. And of course, as long as the Strait of Hormuz will eventually reopen. If you look at Saudi Arabia, it's underperformed a bit, down 1%. Qatar about the same. Abu Dhabi a bit more, 1.5%. But given how serious the situation is, the setup has been quite contained. In fact, would you have also Bahrain, which is a high yield? The setup has been more pronounced. It's close to 2%, given the higher political risk of the potential destabilization and weaker public finances. But I can't say the region has been hit particularly. In fact, the sell-off was more pronounced for high yielders outside the Middle East region, mainly African countries, such like Kenya, for example, was down in commodity importer and especially oil importer. Nigeria, which is a oil producer, which is down 1%. So it's in a way, it's a sort of a similar repricing as GCC countries. And in IG space, the high beta names were affected, like Romania, Hungary. as you can see on the slide here on the screen. Now, if you look at net oil importers such as Chile, Philippines, Peru, and Latam, they hardly moved this week. They were wider like 5 basis points or so. So it looks like more sort of a limited de-risking move rather than a sizable reduction in exposure in the Middle East. There hasn't been any notable shift from oil producers in favor of producers at the expense of oil importers. There's one notable exception, and this relates also to a question from the audience: Turkey. Turkey in the region is more vulnerable to the situation, but because of rising oil prices, inflation is very sticky there. To say the least, it's kind of moving around 30% on annual basis, more or less. And obviously, oil prices higher means quite a bit of a pressure on inflation, and that doesn't sound good. So there has been a bit of a repricing here, and actually I cut my recommendation recently from outperform to market perform. The other countries, Egypt is being impacted down 1%, but given the concern you have on potential attacks from the Houthi rebels in the Red Sea, the repricing has been quite moderate, in fact. So in a nutshell, if the tensions persist, I would say the sell-off could be more pronounced, especially if the Strait of Hormuz remains closed, simply because investors have scaled back a bit on risk, but they remain overwhelmingly long risk across EM, and I guess it's also the case across credit.
Great. Thank you, Regis. So I think that we all know that energy commodity prices are really the crux of this conversation from a market and broader macroeconomic perspective. So I'd be curious to hear from the audience, what is your base case for Brent crude prices on June 30th, 2026? So the end of Q2, kind of medium term, I would say. Do you expect them to be back below $70 per barrel, in that 70 to 80 range, 80 to 90, 90 to 110, or above $110 per barrel? Regis, I actually have a quick follow-up question for you from the audience, and whether you have any thoughts on the effect on China's oil supply with Iran and Venezuela out of the sources. I know that China released a lower GDP figure that got some press overnight, kind of in line with expectations. How are you thinking about the geopolitical impact on China of oil supply?
If you look at most of the oil exported from the region, and it goes to Asia and mainly China, right? It's about 80% overall for the region. So there could be some concern. Now, I guess given the size of China, probably have kind of higher power of negotiations, among oil suppliers, right? So I guess China may not be the one that suffers the most if there is kind of severe pressure on oil prices. I guess countries in Asia like Philippines or Korea, we've seen a big repricing in equity markets, and I guess China probably has some means to get some supply. But still, oil at 100 would be a problem. But I guess it would be a problem for everybody. Right? China would be problematic, but not necessarily for others.
Absolutely. All right. Well, let's see what the audience has to say in terms of their expectations for Brent crude. Okay, so it's a little bit all over the map, though the highest audience vote share is in that $80 to $90 per barrel area, kind of where we are currently. So, not a lot of upside, but just kind of moving sideways from here. And then the bias, I would say, is slightly lower. So 35% of the audience thinks 70 to 80. Another 11.3 is back to below 70. But then we do have some people who are, expecting prices to rise. About 15% of the audience of that 90 to 100. Interestingly enough, less than 2% of the audience in that $110 per barrel area. So, Cedric, I'm going to move to you. Can you outline your scenarios for oil prices? What are some of the key indicators or catalysts that you're looking for when we're assessing whether that 2% of the audience who thinks we're getting to 110 or higher is going to be right?
Well, it's very much up in the air right now, and that will depend on the intensity of attacks. And that's how we've kind of scaled up our scenarios. So I'll start with our baseline core view, which is an average of about 67 for this year. And you can see that in the chart in the middle, where we're a little bit above consensus still. Consensus coming into the year was really low compared to where we thought it would be. And then, of course, we had a lot of geopolitical risk premia from Venezuela to Iran, of course, pushing up prices. And in terms of the quarterly profile, if you look at the chart on the right, we actually expect quite elevated prices in Q1. But then as the conflict is resolved, so as per Ramona's scenario 2, where we're now, that's about a 2 to 3 week conflict, and then we see oil prices coming down quite significantly, and then picking up a little bit later in the year, and that's how we get to our kind of 67 average. Currently, we think, well, we're in the low case, as you can see from the left, where from a physical perspective, the strait is technically open, but not many ships going through, so probably about kind of 10 ships or so. There is some infrastructure that's been targeted. We know that. Some outages, though, but they're generally contained. And then from a market perspective, prices have spiked over the short term, but we would expect a rapid retracement, as I mentioned. Now, how does this start escalating? Well, you have much more kinetic disruption in the strait. So that's infrastructure outages grow because more refineries are attacked. Other refineries come offline just for preemptive measures, or just because if you're not getting any oil out of the region, then what happens is you start to get storage bottlenecks. So you just have to shut down your refinery anyway. And so what we would see is an increased rise in risk premia, higher volatility, and a slightly slower unwinding of the market as and when things get better. And that's just because there's a little bit higher risk premium because there's been more attacks on the infrastructure. And then in terms of the high case, this is where you see a very high intensity of attacks, not only in terms of refinery, but kind of transport infrastructure. You could have, some mining of the Strait of Hormuz as well, and it becomes much more durable in that, and that leads to a structural increase in prices and the term premium, which remains, well into Q2, for example. So those are the different scenarios that we're thinking about. Obviously, we're still around the low case, but that could quickly escalate depending on whether the assets get attacked or not. And possibly one of the considerations as to how much Iran targets some of these assets could also be whether GCC countries respond by sending missiles or fighting on the side of the US and Israel. Then potentially Iran has even a bigger incentive to really attack some of these facilities.
Yeah. So, Cedric, I have a follow up here for you from the audience on some of the comments around um, the U.S. ensuring or providing naval support to cargo going through the streets. Do you think that that's realistic? I don't know. I kind of see that as a little bit far fetched.
So there were actually two potentially positive announcements. Well, three actually. One is the the U.S. administration would help improve kind of with the insurance premiums. Second of all, a bit more of a kind of protection for the vessels, and also France also mentioned that they may also try and protect some of the vessels. But ultimately, I think the fleet going through the Strait of Hormuz is still very vulnerable, because when we were talking to our analysts, they were saying that you don't need the Iranians don't need a navy to attack these ships. They can just send missiles from land, and so these vessels are very exposed, and so I think it's going to be tough to protect the vessels.
Great. So, as we're thinking about your three different scenarios for oil prices, how do you think about that in terms of the transfer mechanism into growth headwinds and inflationary impulses? moving into, a full-on recession signal?
Yeah, so I think the important thing is since the 1970s, we've had about 3 oil-induced recessions. So that's a pretty high number of recessions related to oil prices. Obviously, the world is less energy intensive now, but it's still very important through different channels. So what we did was we ran some econometric modeling, and we looked at oil at 90, 110, and 130. And what we saw was if you go to 110 and 130 for about a quarter or so, it starts to shave off about 0.2 to 0.3 percentage points off of growth, which is, reasonably kind of a big hit to the economy. But more importantly, I think it adds a lot of inflation. So it adds about 1.5 to 2.5 percentage points to inflation. And I actually think that the model probably underestimates the impact on growth, if only because I think there's certain things to consider which I think are more important now. So, for example, because of the high inflation of the past few years, I think while central banks would want to look through this inflation spike as a one-off supply shock, the reality is that the reaction of functions might be a little bit different, and they may have to tighten. So particularly emerging markets with weak balance of payments positions, and which may face a lot of currency pressure on their currency, may have to tighten policy. The other thing to think about, and Regis was alluding to this a little bit, is that the model can't adapt for physical oil scarcity. And when you think about the Strait of Hormuz, most of Asia gets their oil from the Strait of Hormuz. So if you think of countries like the Philippines or Japan, it's a huge amount, like almost 80, 90% comes from the Strait of Hormuz. Now, if it's a short bout of kind of blockages in the strait, that's not a problem. But if it's an enduring one, and let's say Japan, Philippines, other countries start to draw down their inventory, then you're not only getting higher prices, but maybe you actually get a physical shortage, and that would have a much bigger impact on these economies. And last but not least, um, some economies could provide some fiscal subsidies to provide a buffer, but the big challenge is fiscal deficits are very wide more broadly, and so governments around the world have a little bit less flexibility there.
Absolutely. So we've gotten a few questions on how this war is going to impact economies in Asia and globally. I'd be curious to hear from your perspective, what economies are the most at risk or actually positioned to benefit from higher oil prices?
Yeah, so this is a question that our customers are also asking us. And the scatter plot on the left basically plots the current account balance as a share of GDP against the oil and gas trade balance as a share of GDP. And the bottom left-hand quadrant basically are countries that have a current account deficit and are net importers of energy, and in a big way. So you can see a spike in oil prices would hurt Egypt, the Philippines, Turkey, for example. And we already saw Turkey preemptively taking some measures to tighten liquidity conditions in order to avoid capital flights. Now, in contrast, if you look at the top right-hand quadrant, you have Nigeria, Malaysia, Ghana. These are commodity exporters, which would benefit to a degree if you don't consider kind of the impact from financial markets. And then the heat map on the right is a heat map looking at very similar indicators, but also including things like budget balance, real interest rates, and where inflation is, whether it's above target or not. And it's to capture a little bit of the kind of ability and the flexibility or lack of flexibility policy constraints that economies have from a fiscal and monetary policy perspective. And here we see Egypt is higher risk, Poland higher risk, Turkey higher risk. But this is only one way of looking at it. You could look at it different ways. For example, I know Ramona, for example, has been talking about one of the big sensitive points for Egypt is the reliance on capital flows and kind of foreign investments, not direct but capital. And actually, if you look at the IIF data over the past few months, we've seen a surge of flows into bond markets and equity markets to emerging markets over the past 2 or 3 months or so. And if this unwinds, then several of these economies which have current account deficits and are reliant on capital flows become much more vulnerable.
You mentioned Cedric, Egypt. We've been flagging the risk from portfolio investments because it was a major source of FX coming into the country, and a real the yields they were offering were really attractive. But what we saw over the past in the 2 weeks run in the to February 24 and even after, a like more than $3 to $4 billion in outflows. So that triggered a lot of pressure on the currency. On the positive side, it was the first real test for the authorities. So they signaled it's a shift from previous stance whereby they burned reserves to keep the exchange rate stable, and now they are letting it absorb this shock. So it's a positive signal. I want to add few words on just growth and economic implications for the GCC, since we're talking about it in this section. Basically, we've done some revisions to our growth forecast for GCC countries, of course, Israel, Iran, Jordan as well. So just to name few, mostly for the GCC countries, we've seen disruption to tourism, aviation, logistics sectors, negative sentiments. So the real drag is on the services and the domestic demand as well. And among countries, the exposure and the impact is not uniform. So I would say, given the focus of Iranian retaliation on the UAE, Qatar, Kuwait, and Bahrain, so they faced the sharpest impact compared to Saudi and Oman, which were less targeted. They kept their airspace open, and hence we've done smaller revisions to them.
So, Ramona, I have a follow up for you from the audience. So, if we are thinking about the Strait of Hormuz being closed or effectively closed to travel, how long can Iran realistically sustain that? I mean, don't they kind of depend on it the most?
Well, yes. Exactly. When we were viewing like how would Iran behave, like, or use, I call it, use the Hormuz card, I thought it would be a measure of last resort because it exports all of its oil through the strait. But then given the threat it's facing, it used it on the first day. I would say they would sustain it as long as for several weeks, I would say, just because if it's part of the plan, and this plan has been probably preparing, been preparing for since June 25, since the last war, they can't sustain it, or it can be no, they can't, and they used it in the first day to increase the pressure, and then eventually they will have to let it pass. But just one thing here, the problem with Hormuz that even if the war ends now, navigation, it will take time to normalize. So it's not like it's open and everyone will go back on day one. There are a lot of hurdles and a lot of it will take 2 to 3 weeks for navigation to come back. This is from my conversations and understanding from our operation risk team as well.
Yeah, I think that's a great point. And perhaps on the other side of this, on the reopening, that's where the naval escorts and insurance guarantees actually come into play. I think that that's kind of far fetched while the conflict is live or hot. But on the other side of this, there's going to be a tremendous kind of loss of confidence, or at least concern for safety. We have actually two questions from the audience on the likelihood of Iran intensifying attacks on essential assets across GCC countries, like desalination plants. Do you have any thoughts there, Ramona?
I've been thinking about this, and because we've been so focused on oil and energy and implications on the markets and the global markets, I would say this would be a declaration of war, like this is a strategic GCC countries. They rely on desalination plants. So I would say for this to happen, like this is Iran inviting these countries to join the war.
Well, I don't know that we necessarily want that to happen for sure. All right. So we are going to move on to talking a little bit more about markets and risk reward and opportunity. Before I get into our panelists, I would love to hear from the audience. Where do you see the most attractive risk reward opportunity right now? Are you buying that dip in government bonds on inflation fears and going long duration? Are you more aligned to short duration strategies like Zach was outlining, given that yields may be higher and sustained inflation? Are you getting long EM and GCC oil exporters or long USD short EM FX, more of a safe haven trade? Are you just going all in on energy sector credits, buying that high yield energy? Or are you just kind of sitting on your hands, cash, and staying on the sidelines until clarity emerges? I would love to hear from the audience. And Zach, while we do that, we have a question from the audience actually on why on earth are IGCDS spreads tightening right now?
That's a great question. It's a bit confounding. When we looked at what cash spreads had done leading into this conflict, they had widened out quite a bit on the order of about, call it low double digits for many sectors. And so I think one thing to consider coming into this is the market had priced in some of this risk. It seems like the outbreak into all out war was a little bit sooner. And I think to the point of a few of Ramona's comments, it seems like Iran has intensified fairly quickly and played some of its cards more rapidly. All that to say, um, the starting point matters. We think spreads are still extremely tight. The one thing I'm kind of considering is this upward pressure on government bond yields probably takes some of the spread pressure off for now. Over the longer run, we do think spreads are vulnerable to more sustained widening as some of the economic concerns of this begin to play out.
All right, Zach, that's super helpful. Let's see what the audience is doing in markets. Okay, so we have over a third who are staying in cash, sitting on the sidelines until clarity emerges. That very much aligns with the conversations that I had with clients earlier this week. The second most preferred strategy is that short duration. 25% of the audience is just staying in the front end of the curve on sustained inflation fears. Then we have long energy sector credits in the third spot at 15.5% of the audience. And then I would say it's kind of an even mix of long duration, long EM, or long USD short EM FX safe havens. Okay, so Zach, I would love to hear from you. How are you thinking about the path for the Fed and Treasury yields over the course of this year? What is the actual threshold for the Fed to, hold or hike rates because of a commodity price shock? And I think that a lot of people are thinking about the 2022 Russian invasion of Ukraine and the playbook there. How do we differentiate what is happening today to what happened in 2022?
That's a lot, Winnie. I'm going to try and do that as quickly as I can. I think first thing on the Fed's already become more concerned about inflation relative to weak labor markets coming into this. And that was evident with the January meeting minutes. And so I think that their willingness and ability to look through a near term shock is relatively diminished recently. And also thinking about the level of inflation now gives it little flexibility there. So that's a very clear risk to our base case coming into this year, which is 3 rate cuts as we were more focused on further labor market weakness, which we still think is in play, but the latest news and developments certainly complicate that for the Fed. And I think about what ultimately happens from here, it's feeling pretty binary. Either we are going back to 4.5%, maybe we touch 475, like I mentioned before, we would see those as likely buying opportunities, or this tips into a global recessionary fear and we're going to 3 to 3.5% on the 10 year. So trying to take those two barbells and coming up with a, let's say, probability weighted outcome feels very difficult. I think overall, coming into this year with a more cautious view on credit from a fundamental perspective and a more constructive view on duration, I still feel pretty good about that ultimately playing out. I think if we do have this relatively short conflict resolved over the next couple of weeks that Cedric and Ramona have pointed out, I think ultimately the concern will shift to demand destruction from these higher oil prices And that's something that we had already been calling for amid this weakening labor market backdrop. So I think overall, right now, I'm thinking about the latest developments strengthening our core case that we had coming into this year. It's a little bit tough to separate signal from the noise right now, but I'm comfortable with our longer run, lower yield call, wider spreads. And for total return focused investors, staying invested in IG credit looks good. Being more cautious from an excess return perspective is kind of how I'd stay the course for now.
Because I think that that makes good sense. And as we were heading into this year, one of our big questions was how do corporates maintain really strong margins amid decelerating pricing power across a wide range of sectors, especially within the consumer, and some kind of sticky input cost pressures within commodities already. This is really just kind of amplifying that, in my opinion. So, while we were not calling for this war in Iran to break out this year, I do think that a number of our kind of core scenarios are actually quite supported by the playbook that we're trying to consult right now. So, Regis, last year, US dollar weakening was very helpful to EM issuers, also a lot of flows for EM and robust demand. We've seen the dollar strengthen a little bit, maybe less than I would have expected given how volatile everything has been. How are you thinking about EM fundamentals and technicals? Are they, at risk of a very severe erosion over the course of this year? And then where are you most concerned about and where are you trying to kind of hide out in EM portfolios?
To answer your question, I mean, a declining dollar has helped emerging markets overall. Weaker dollar means easing still debt cost and lower cost of imports. If you look at EM exports, they tend to be less sensitive to FX moves. So, bottom line, a weaker dollar tends to be quite positive for EM. Now, in your questions, I think that in a way there's two scenarios. I mean, one is the dollar appreciation going forward, it remains moderate. And in that case, I don't see meaningful erosion of EM fundamentals. Credit fundamentals in EM have proven to be quite robust. Last year, we had something like 35 EM upgraded across EM major markets and frontier markets versus only, I think, 7 downgrades. If you look at, in many cases, fiscal discipline is better in a way than developed markets. I mean, of course, we can look into details, but also terms of trade remain favorable globally for EM, and FX reserve continue to rise. Will have continued to rise. They're back to sort of long-term average after this kind of big dip post-COVID. And I think growth is going to be still significantly higher in the developed markets. So I'm not overly concerned in this kind of scenario. The second scenario is obviously dollar appreciation is very strong. Then obviously EM fundamentals would suffer more. But I tend to think this is a sort of a likely scenario. In fact, we still see a global demand for diversification across the globe, and EM. If you look at the risk, of course, this the GCC countries or GCC region now a bit of a focus, but overall EM risk is seen as the gap between developed markets with developed markets is narrower than in the past. So there's clearly still structural demand for EM beside or beyond the dollar appreciation. In terms of allocation, I'm not particularly concerned just yet as far as GCC countries is concerned. Saudi Arabia has some buffers, with still lots of reserves, and they have access to the Red Sea. Hopefully, they won't have any attacks there and blocking the way. But Oman has shifted a bit my view, a bit more benign. Oman has seen some attacks, but obviously they have access to the Indian Ocean, so that makes the economy more resilient to this kind of shock. They can continue to export. I've turned already market neutral on Turkey for the reason I mentioned, because of high inflation and the impact of oil. Now, if I'm more concern is about still high yield. The high yielders, namely Egypt, for example. The Egypt, it's not so much because of the current situation. It's because I see EM high yield very tight, and I think we're meant to have some sort of repricing going forward. Asia is quite expensive, Philippines in particular. So this is no, I would see the value. I wouldn't see the value neither in Eastern Europe. As Cedric mentioned, these countries tend to be quite sensitive to oil prices. If I had to point at one direction, it would be LATAM, right? Countries like Chile, Peru, Colombia. I think they will outperform. South Africa is in decent shape as well, improving slowly, I would say, but still a positive trend. But yeah, spreads are tight overall. But if you have a bit of repricing or more pronounced repricing, I think it's still a good place to be relative to the rest of the world. And in terms of risk reward, EM offers a pretty diversified risk profile. Yeah, that would be my call at this point.
Great. Thank you, Regis. So, Cedric, I want to bring you in and talk a little bit about equity markets. I think that we've seen some days of risk off, but the drawdown has not been particularly significant, at least in the US. US equities, though, were already feeling a little bit wobbly last week, especially AI, private credit, BDC concerns. All of those were very front and center. What are you thinking about kind of the path for US equities, and how severe of a drawdown do we need to see to really inflict damages on consumers who have benefited from that wealth effect of rising asset prices?
Thanks, Winnie. That's a really good question because actually at the start of the year, the equity market was looking generally good in the sense that you had strong U.S. growth, which would underpin earnings, which were, they look good. Profit margins are kind of ticking up across the different groups, whether it's technology, S&P, small caps even. The profit margins were improving as interest rates were coming down. And then what we saw was greater breadth where your tech stocks weren't doing fantastic, but the rest of the companies started to kind of push higher and hit new highs, and so we saw improved breadth. But I think, as you mentioned, the last couple of weeks we saw a few more headwinds emerge. So we had huge concerns about AI-led disruption, and that saw the software sub-index of the S&P drop 30% since last October, I think, and that's really struggled to kind of recover. And I always think when one of the leading sectors is very weak, that is a little bit of a kind of warning signal. It's not always a warning signal, but it's certainly something to watch. Because if you remember back in 2005, first it was the home builders that looked really bad. And then a couple of years later, the financials looked bad. And then only after about a year that the financials peaked, did the S&P peak. So sometimes you got to look at the subcomponents that were leading it. Now, I'm not saying the same thing is going to happen, but it's certainly more like one of the things to look at. And the other thing I think where we have to look at is midterm years are typically quite volatile for equity markets, where you have larger than normal drawdowns because of the volatility, and you have on average lower return years compared to, let's say, the other years. Now, if you add to that concerns that we have an inflation pressures which are going up, maybe the Fed doesn't cut as much as was priced in, and that could certainly hurt the performance of equities. So certainly the outlook for equities, while still reasonably okay given the fundamentals, at the margin, if you think about market pricing, market positioning, and the sensitivity to potential repricing of interest rate kind of trajectory, then I think it leaves equities still a little bit at risk. But I've been surprised at their resilience.
Mhm. Yeah, it has been really surprising at resilience. Do you have a thought in terms of like S&P needs to be down 10%, 20% to really inflict damage on that K-shaped consumer, right? Like if we know that the wealth effect has been supporting a lot of spending, at what point does that go away?
That's a good question. I mean, even if you see a 10% decline, it's still up from, several quarters ago. So it is at the margins. I think where it hurts is more through the kind of consumer confidence lens. So if equity markets are falling, then people start to worry. Businesses don't invest as much. Employment doesn't look as good. So it's the wealth effect, yes, for sure. But I think it's the other kind of confidence channels that also impact both consumer and business.
Yeah, that vicious
So
cycle.
15%. Yeah, I would say 10-15%, kind of scares people. Actually,
Yeah.
nowadays, 3% scares people.
I mean, it's when we're moving up and down 3% on a day-to-day basis that scares me. It's over time, that's not as much of a big deal, but the minute by minute up and down 3% has been a lot to manage for sure. So Zach, let's wrap it up with corporate credit. We have a couple of questions from the audience. One is which fixed income sectors or markets are set to benefit? Another one is, does MBS make sense in 2026? How are you thinking about putting it all together for US investment grade and MBS?
So I know we're over. I'll keep it very brief. I'd say if you're in the inflation camp, really no fixed income is going to be immune to that pain. I think MBS has tightened substantially, even relative to credit. So while it had been one of our preferred ways to avoid US credit risk, I think that relative attractiveness has shrunk pretty dramatically. And when we think about sort of what sectors and how we were positioning coming into this year, we had an underperform on retail and consumer goods, particularly on the discretionary side. I think that's going to work out fairly well. We've had an outperform on financials, which we think could perform more defensively. You could see telecom and transportation is probably a little bit more nuanced. Those are outperformers we had coming into this year, but we also think that those could perform well in this environment that we're seeing going forward. So those are kind of some of the sectors we like and don't like. That's not really changed from this. I think if anything, this strengthens our case for some of those calls. Don't love MBS as much. And if you're in the inflationary camp, it's going to be a tough year for fixed income. I hate to bring up 2022, but probably not a terrible corollary. But if you're kind of in our camp, that more of this growth weakness, labor market concern, discretionary income concern comes into play, then fixed income probably can still do fine from a total return perspective.
Great. Thank you, Zach. Yeah, and I think that we just kind of reiterate our cautious on credit risk, getting increasingly constructive on duration, kind of depending on whether we hit some specific yield thresholds. We've been very cautious on the BSL space amid some credit concerns that there. And just, in general, I think that right now is the time to identify very specific name by name opportunities. On this slide, we have a brief overview of just some of the recommendation changes that our CreditSights analysts have implemented since Monday alone. We do have a Middle East reading list that incorporates all of the different CreditSights views on the Middle East from the US, Euro, and Asia-based teams. We're updating that on a regular basis, so definitely check that out. And I guess that we are going to just go ahead and wrap up our webinar. We are a little bit over time. I very much appreciate everyone tuning in. Thank you to Zach, Cedric, Regis, and Ramona, who had to drop for another call. She is clearly the woman of the hour right now, for joining me today for this conversation. Thank you all for listening in. If we didn't get to your question, I'm so sorry. We will be following up directly with people. If you have any follow-ups, feel free to reach out to any of us directly. And good luck over the next few weeks. We'll be back at the end of the month with our Q2 2026 outlook. It's going to be a wild ride until then. And with that, we'll conclude our webinar.